Welcome to the deep dive. Today, we're tackling something pretty fundamental to the financial world, financial reporting standards.
Yeah, absolutely. These are the nitty-gritty rules.
Hmm.
Legislation give you the big picture, but the standards, they tell you exactly how to account for things.
They're the detailed blueprint, really. And to help us navigate this, we're using Alan Melville's International Financial Reporting, a practical guide, the 2023 edition.
And crucially, it's updated to January 1st, 2022. So it's pretty current for when it was published.
Which matters because this area doesn't stand still, does it?
Not at all. It's constantly evolving with business practices in the global economy.
Now, different countries have their own bodies. We've got the FRC here in the UK.
And the FASB over in the US, sure.
But today, we're zooming in on the international standards, the ones from the IASB, the International Accounting Standards Board.
Right. Their big goal is, essentially, one single set of high-quality global standards to build trust, make things transparent.
So, our mission today, to really get to grips with these IFRS standards, understand the core ideas, the main components.
So by the end, hopefully those company financial statements will feel a bit less intimidating.
Exactly, and it helps to know the structure, right? There's the IFRS Foundation.
Which has two main boards now. There's
Yeah.
the IASB doing the IFRS accounting standards we're talking about today.
And the newer one.
The ISSB, International Sustainability Standards Board. They handle the IFRS Sustainability Disclosure Standards. Slightly different names, note.
Good point. So, listener, we're going to pull out the key bits of the accounting standards for you, make it clear. Right, let's start at the beginning. Why do these reports even exist? What's the main goal?
Well, the core purpose, according to the framework, is to give useful financial information to the primary users.
Primary users being?
Your existing and potential investors, lenders, other creditors, basically the people deciding whether to put money into the company.
So it's all about helping them make decisions on allocating resources, buy shares, lend money, that sort of thing.
Precisely. But, others find it useful too. Employees, customers, suppliers, the public. They might look at it to see how the company's doing, its local impact.
Right. A company's health affects more than just investors. What about management? Surely they use these reports constantly.
They do, but they have access to way more internal detail. These general purpose reports are really geared towards outsiders who need that standardized view.
Okay, so for the outsiders, what specifically should these reports tell them?
They need to show the company's economic resources, its assets, and the claims against those resources, its liabilities and equity.
Like a snapshot.
Exactly. And crucially also, how those resources and claims have changed over time, because of performance profits or losses or other things like issuing shares. Both the snapshot and the changes are vital.
Got it. So we know who they're for and what they should broadly cover, but what makes the information useful? Are there specific qualities it needs?
Definitely. The conceptual framework outlines these qualitative characteristics. There are two fundamental ones: relevance and faithful representation.
Okay, relevance. What does that mean in this context?
It means the information has to be capable of making a difference to a user's decision. If it can't influence a decision, it's not relevant. Simple as that.
And how does it make a difference?
Two ways, mainly. It needs predictive value or confirmatory value, or both.
Predictive value helps you guess the future.
Sort of, yeah. It helps users form expectations about future outcomes. Like, past performance data can give clues about future profitability. It doesn't have to be an explicit forecast, but it helps build that picture.
Right, like looking at past weather patterns to guess tomorrow's weather. And confirmatory value.
That helps users confirm or maybe correct their previous ideas. So if you thought a company was doing really well, the report should either back that up or show you, actually, maybe not. It's feedback.
Okay, so relevance is about looking forward and checking back. Makes sense. The other fundamental one was faithful representation. What's that about?
Faithful representation means the numbers and descriptions actually match the economic reality they claim to represent. It's about being truthful and reflecting the substance of things.
And what makes it a faithful representation?
Three things. It needs to be complete, neutral, and free from error.
Completeness meaning everything necessary is included, no major omissions.
Exactly. Neutrality means it's unbiased, not slanted to make the company look better or worse, just objective.
And freedom from error, does that mean perfect accuracy?
Not necessarily perfect, especially with estimates. But it means there are no material errors or omissions in the description of the phenomenon, and the process used to produce the reported information has been applied with no errors. The process needs to be sound.
Okay, so relevance and faithful representation are the big two, the must-haves. But you mentioned enhancing characteristics too.
Yeah, these make useful information even more useful. They are comparability, verifiability, timeliness, and understandability.
Comparability sounds crucial. Comparing a company over time or against its peers.
Absolutely. It lets users spot trends and see how a company stacks up. Consistency in applying accounting methods is key here. If you keep changing how you account for things, comparison becomes really hard.
Right. And verifiability.
That means different, knowledgeable people looking at the same information would broadly agree it's a faithful representation. Doesn't mean they'd get the exact same number down to the penny, especially with estimates, but they reach a similar conclusion, like getting a second opinion.
Okay. Timeliness. That seems obvious. Get the info out quickly.
Pretty much, information is more useful if it's available before it loses its ability to influence decisions.
Mm.
Old news isn't much help. There's a balance, though, between being timely and being accurate and complete.
Sure. And finally, understandability.
This means presenting information clearly and concisely. It assumes users have, a reasonable knowledge of business and are willing to study the information. It's not about oversimplifying complex stuff, but making it accessible.
Okay, so all these qualities work together. Let's move on to the actual statements themselves. What are the main parts of a complete set of financial statements under IFRS? What does IAS 1 say?
IAS 1 lays out 5 main components. First, the statement of financial position, that's your balance sheet, the snapshot of assets, liabilities, equity at a point in time.
Right.
Second, the statement of comprehensive income. Shows performance over a period, includes profit or loss, and something called other comprehensive income, or OCI.
We'll come back to OCI. What else?
Third, the statement of changes in equity. Shows how the owner's stake changed during the period. Fourth, the statement of cash flows, tracking the cash movements.
Covered by IAS 7, that one.
Yep. And fifth, crucially, the notes to the financial statements. They're an integral part, providing all the extra detail and explanations.
So 5 key pieces. You mentioned other comprehensive income OCI. How's that different from the normal profit or loss?
Well, most income and expenses go into profit or loss. But IFRS requires certain specific items to be shown separately in OCI. Often these are things like, say, gains on revaluing property or certain actuarial gains or losses on pension funds, things considered a bit different from core operational performance.
I see. So it highlights certain gains or losses outside the main profit figure. And can companies present profit or loss separately?
Yes, they have a choice. They can present a single statement of comprehensive income, or they can present 2 statements. A separate income statement, showing just profit or loss, followed by a statement of comprehensive income that starts with that profit or loss and then adds the OCI items.
Ah, okay. Gives a bit more clarity perhaps on the core results first. Does IAS 1 dictate a specific format for these statements?
No, it doesn't prescribe a rigid format, but it demands clear identification and labeling, and typically they're prepared at least annually.
And often in annual reports, we see more than just these statements, right? Like a management commentary.
Exactly. IS1 mentions this management review or commentary. It's management's perspective, their analysis of performance and position. It's technically outside the scope of IFRS standards themselves, but the ISB does offer some non-binding guidance on how to prepare it.
So the statements are the standardized bit, the commentary is extra flavor from the company. Got it. Let's dig into some underlying principles from IAS 1. What assumptions are made when preparing these statements?
Okay, a huge one is the going concern assumption. You normally assume the company will continue operating for the foreseeable future. It's not about to collapse or liquidate.
And if that assumption isn't true?
Then the whole basis of preparing the accounts changes, and that fact and the different basis used has to be disclosed very clearly. It affects how assets and liabilities are valued, you see.
Makes sense. What else?
The accrual basis of accounting. This is fundamental. Transactions are recognized when they occur, not when the cash moves. So you record revenue when you earn it, expenses when you incur them.
Right. Matches income and expenses to the period they relate to, regardless of cash flow timing. Except for the cash flow statement itself, obviously.
Precisely. That's the exception.
Any other key features?
Materiality and aggregation. Information is material if leaving it out or misstating it could influence users' decisions. You have to present material items separately. But immaterial stuff can be grouped together, aggregated, keeps things focused.
Practicality, really. Don't clutter the reports with tiny details.
Exactly. Then there's consistency of presentation. You should classify and present items the same way from one period to the next. That helps with comparability, tracking trends.
Makes sense. And finally,
Comparative information. You must show the previous period's figures alongside the current periods for all amounts reported. Allows users to see changes, calculate growth rates, etc. Essential context.
okay, solid principles. Now let's define the basic building blocks, the elements of financial statements.
Right. The conceptual framework defines 5 key elements: assets, liabilities, equity, income, and expenses. These are the fundamental categories.
Okay. Assets resources controlled by the company from past events, expected to provide future economic benefits. Liabilities present obligations from past events, expected to result in an outflow of resources. Equity, the residual interest, assets minus liabilities. Pretty standard. What about income and expenses in this framework's view?
Income covers increases in assets or decreases in liabilities that boost equity other than contributions from owners. So it includes revenue from normal business and also gains, like selling an asset for more than its book value.
And expenses.
The opposite, decreases in assets or increases in liabilities that reduce equity other than distributions to owners, like dividends. Includes costs of running the business and also losses.
Okay, simple enough. Income boosts equity, expenses reduce it, generally speaking. But when do these actually get recorded? The recognition point.
Recognition. An asset or liability is recognized only if, well, first it meets the definition, and second, recognizing it provides useful information, meaning it's relevant and faithfully represented. There used to be explicit probability and measurement reliability criteria here, but the revised framework focuses more on the usefulness of the resulting information. Derecognition is when it stops meeting the definition, like when you sell an asset or settle a debt.
So it's not just does it exist, but is reporting it useful? Got it. Now measurement. How do we put a number on these elements?
The framework doesn't force one single method. It acknowledges different measurement bases might be appropriate. Common ones are historical cost, what you originally paid or received.
The traditional way.
Often, yes. Then there's current cost, what it would cost today. Realizable value, what you can sell an asset for. And present value, which considers the time value of money.
Present value. Can you give us a quick example? It trips some people up.
Sure. Let's say you're promised £1,000 in 1 year. If the interest rate or discount rate is 8%, that £1,000 isn't worth £1,000 today. It's worth about £926. Because £926 invested today at 8% would go to £1,000 in a year. It discounts future cash back to its value now.
Right. Money now is worth more than money later. So how do companies choose between historical cost, present value, fair value, etc.?
It's often a trade-off. You have to think about what provides the most relevant information versus what can be faithfully represented. Current values might be more relevant, but harder to measure reliably, especially if there's no active market. Historical cost is usually reliable, but maybe less relevant over time. Measurement uncertainty is a big factor here. You pick the basis that gives the most useful info overall for that specific item.
Judgment call then, balancing relevance and reliability. Okay, let's circle back to the main statements. Statement of financial position, any key structural points in IAS 1?
A big one is separating current and non-current assets and liabilities. Current usually means expected to be realized or settled within 12 months or the company's normal operating cycle. Everything else is non-current.
That helps assess short-term liquidity, right? Ability to pay immediate bills?
Exactly. For the statement of comprehensive income, we mentioned separating profit or loss from OCI. Most things hit profit or loss. OCI catches specific items like certain revaluation surpluses under IAS 16. Sometimes these OCI items might get recycled into profit or loss later, sometimes not.
Okay, a sort of holding pen for certain gains and losses. What about the statement of changes in equity? What does that show?
It breaks down the changes in each equity component: share capital, retained earnings, those OCI reserves showing how they move from start to the end of the period. It shows the impact of profit loss, OCI items, and any transactions with owners, like dividends paid or new shares issued.
And the statement of cash flows, IAS 7?
Yeah, that tracks actual cash movements, splitting them into operating activities from core business, investing activities, buying and selling long-term assets, and financing activities, debt, equity changes. Helps see where cash comes from and where it goes.
Vital for understanding cash generation and funding. Finally, the notes, you said they're integral. What kind of crucial info is in there?
Oh, loads. The basis of preparation, the specific accounting policies chosen, like depreciation methods, judgments and estimates made by management, breakdowns of line items in the main statements, disclosures required by other specific standards. It's where you find the real detail behind the numbers,
The story behind the figures.
pretty much. And IAS1 notes that very rarely, if following a standard would be seriously misleading, a company might depart from it. But that's exceptional and needs massive disclosure explaining why, what the impact is, etc.
Sounds like a last resort.
Yeah.
Okay, let's talk about accounting policies, changes, and errors. IAS 8, right?
Correct. IAS 8 says you pick appropriate policies aligned with IFRS and apply them consistently. Consistency aids comparability over time.
But what if you need to change a policy?
You can, but only if a standard requires it, or if the change results in more reliable and relevant information. You can't just chop and change for no good reason.
And if you do change, how's it shown? Just start the new way.
No, generally it's applied retrospectively. You basically go back and restate the previous year's comparative figures as if you'd always used the new policy.
Yeah.
You also adjust the opening balance of equity for the earliest period shown to catch the cumulative effect up to that point.
So you're rewriting history, in a sense, to make the comparison valid.
Exactly. It ensures you're comparing with like across periods under the new policy. Otherwise, a change could distort the apparent trend in performance.
Okay. What about fixing mistakes from previous years? Prior period errors?
Similar treatment. If you find a material error from a past period, mass mistake, misapplied policy, fraud, whatever you have, to correct it retrospectively too. Restate the effective prior period numbers, adjust opening equity, same principle. Make the past accurate and comparable.
So retrospective application is key for both policy changes and error corrections. Right, let's touch on some specific asset types to see how these rules work in practice. Property, plant, and equipment, PPE, IAS 16.
Okay, PPE. Tangible assets held for use in the business, used for more than one period. Initially measured at cost, purchase price, plus any cost to get it ready for use.
And after that, how are they valued?
Two choices, the cost model or the revaluation model. Cost model is simple. Cost less accumulated depreciation and any impairment losses. Depreciation spreads the asset's cost over its useful life.
And there are different ways to depreciate.
Yep. Straight line, even spread, diminishing balance, more depreciation early on, units of production based on usage. You pick the method that best reflects how the asset's benefits are used up.
And the revaluation model.
That carries the asset at fair value at the revaluation date, less subsequent depreciation impairment. Revaluations need to be frequent enough to keep the value current. Increases usually go to OCI, revaluation surplus and equity. Decreases usually hit profit or loss. Complex rules apply.
Big difference in reported asset values depending on the model chosen. What about borrowing costs to build or buy these assets? Say, interest on a loan for a new factory.
IAS 23 covers that. If the borrowing costs are directly linked to acquiring or constructing a qualifying asset, one that takes a substantial time to get ready, those costs must be capitalized, added to the asset's cost during the construction period. Other borrowing costs are just expensed.
Treats the interest as part of the asset's construction cost. Okay.
Yeah.
How about investment property, IAS 40? Different from PCE.
Yes. Investment property is held to earn rent or for capital appreciation, not for use in the business. Think of an office building rented out by an investment company.
And how's that measured?
Again, a choice, cost model or fair value model. But under the fair value model for investment property, changes in fair value go directly to profit or loss each period. And even if you use the cost model, you generally still have to disclose the fair value in the notes.
So fair value is more prominent here, hitting the P&L. What about intangible assets? Patents, brands, IAS 38.
Right. Non-physical assets. Key distinction. Internally generated versus acquired. Internally generated goodwill, like a good reputation you built up yourself, cannot be recognized as an asset. Too hard to measure reliably.
Interesting. But goodwill you buy in an acquisition is recognized?
Yes, under IFRS 3. For other internally generated intangibles, like R&D, IAS 38 splits it. Research costs are always expensed. Development costs can be capitalized as an intangible asset, but only if you meet 6 strict criteria proving technical feasibility, intent to complete, future benefits, resources available, ability to measure costs, etc.
High hurdle for capitalization then, and measurement after recognition. Cost or revaluation again.
Similar choice. Cost model, cost less accumulated amortization and impairment, or revaluation model. But revaluation for intangibles is rare because you need an active market for that type of asset, which often doesn't exist. Amortization is like depreciation for intangibles with finite lives. Indefinite life intangibles aren't amortized but are tested for impairment annually.
Okay. Which brings us to impairment of assets, IAS 36. What triggers that?
An asset is impaired if its carrying amount, what it's booked at, is higher than its recoverable amount. Recoverable amount is the higher of its fair value, less cost to sell, and its value in use, the present value of future cash flows from using and eventually selling it.
So you write it down to the recoverable amount.
Exactly. The difference is an impairment loss, usually hitting profit or loss. You have to assess for impairment indicators regularly, and goodwill and indefinite life intangibles must be tested at least annually, indicator or not. Ensures assets aren't overstated.
Okay. Quickly then, inventories. IS2, goods held for sale.
Measured at the lower of cost and net realizable value, NRV. Cost includes purchase, conversion, getting ready. NRV is estimated selling price less cost to complete and sell. It's a prudence concept. Recognize losses early if NRV drops below cost.
And calculating cost, FIFO, LIFO.
IS2 allows FIFO, first in, first out, and weighted average cost. LIFO, last in, first out, is specifically not allowed under IFRS.
Got it. And financial instruments, a huge area, IFRS 9, IAS 32.
Huge and complex. Basically, contracts creating a financial asset for one party and a financial liability or equity for another. Initial measurement is fair value. Subsequent measurement depends on classification, amortized cost, fair value through OCI, FVOCI, or fair value through profit or loss, FVPL. Depends on the business model for managing the asset and its cash flow characteristics. Liabilities mostly amortized costs or FVPL.
And things like convertible bonds.
Compound instruments.
Yeah.
IAS 32 requires splitting them into liability and equity components on day one. Yeah, as you say, a whole deep dive in itself.
Definitely. Okay, shifting to the other side, liabilities and equity, provisions, IS 37.
Provisions are liabilities where the timing or amount is uncertain. You recognize one if you have a present obligation from a past event, an outflow of resources is probable, and you can reliably estimate the amount. Think warranties, restructuring costs.
And if it's only possible or can't be reliably measured.
Then it's a contingent liability. Not recognized on the balance sheet, but usually disclosed in the notes if it's not remote. Same idea for contingent assets, possible assets, disclosed if inflow is probable.
Okay. Leases, big changes with IFRS 16, right?
Massive change for lessees. Generally, lessees now recognize a right-of-use asset and a corresponding lease liability for almost all leases. Puts leases onto the balance sheet. Exceptions for short-term, under 12 months, and low-value leases.
More transparency on lease obligations then. Employee benefits, IAS 19.
Covers everything from wages, short-term benefits, to pensions, post-employment, long-term benefits, termination pay. Accounting varies hugely. Defined benefit pensions are particularly complex, involving actuaries. Share-based payments have their own standard IFRS 2.
And income taxes, IAS 12.
Deals with current tax, payable now, and deferred tax. Deferred tax arises from temporary differences between the accounting carrying amounts of assets, liabilities, and their tax bases. Represents future tax effects.
Okay. And equity itself, we know it's the residual interest.
Yeah, main components are share capital, retained earnings. IAS 32 helps distinguish liabilities from equity. The statement of changes in equity tracks all the movements.
Right. So we've covered a lot of ground. Any other really key IFRS areas we should just flag for awareness?
Oh, plenty. Revenue recognition under IFRS 15, that 5-step model is huge. Business combinations, IFRS 3 for acquisitions, consolidated financial statements, IFRS 10 for groups, investments in associates in joint ventures, IAS 28, IFRS 11, related party disclosures, IAS 24 for transparency, foreign currency, IAS 21, financial instrument presentation and disclosure, IAS 32, IFRS 7, earnings per share, IAS 33, operating segments, IFRS 8, even rules for hyperinflationary economies, IAS 29. It's comprehensive.
Truly covers the waterfront. And you mentioned the IFRS for SMEs standard earlier. How's that different?
It's a simplified, self-contained standard for small and medium entities. Significantly less complex, fewer choices, reduced disclosures. For example, goodwill impairment testing isn't automatically annual. All intangibles are treated as having finite lives. Aims for a balance between usefulness and the cost of fit for smaller companies.
A proportionate approach. Makes sense.
Yeah, high quality but more manageable.
Well, this has been incredibly insightful. We've gone from the core purpose and principles right through to specific standards for assets, liabilities, and more.
And the big takeaway really is that this whole IFRS framework exists to provide relevant, faithfully represented information. It's about clarity, comparability, ultimately helping users make better economic decisions.
Though it's clear each standard we've mentioned could be its own deep dive session, the detail is immense.
Absolutely. We've really just scratched the surface today, trying to give that foundational overview of the principles and the landscape.
So, for our listeners, maybe think about this. Now you know a bit more about what goes into these reports. How might that change how you read financial news or look at an investment? Is there one area, maybe revenue or leases or impairment, that really sparked your interest to find out more?
Yeah, food for thought. It's a complex world, but hopefully a bit less opaque now.
Indeed. Thanks for joining us on the deep dive.